And we are live. Hey, everybody. Welcome to another JMMB Goal Getter live. I'm Carrie Ann Stimson, and I'm the Group Chief Marketing Officer of JMMB. And it is our absolute pleasure to be coming to you again live from home for another awesome JMMB Goal Getter Live. Welcome again, everybody. Please drop a comment. Tell us that you're watching, whether you're watching us live or you're catching us on the replay. It's all good. We're still happy to have you here. Drop us a comment. Tell us that you're here. Hey, Damien. Hey, Jermaine. What's going on? Haven't seen you in a long time, but I know we're in touch every now and again. Welcome. Hi, Shanique. Shanique is here with us virtually every week. Welcome, guys, from Facebook. If you're listening to us, we're on Facebook. We are on Twitter/Periscope, and we're also on YouTube tonight. As usual, you know the drill. We're broadcasting live. We're going to have another awesome conversation again, where we're going to be talking about investing 101. And I see everybody again dropping in. Hey guys, folks coming in from YouTube. And I'm saying these names and I hope I'm pronouncing them right. Kefash, I don't know. I'm hoping I'm pronouncing your name right. Welcome. Donna and Tony and Shauna and Raquel. Or whether you come every week, whether it's your first time, we're happy to have you. So again, if you know anybody who needs to be in this conversation, call them, WhatsApp them, text them, DM them, tag them, tell them they need to be right here, because we are going to have another fabulous conversation. And we're going to be talking about investing 101. We're going to be breaking down this thing called investing all the way down, because sometimes we feel that, investing is only for rich people and investing is only for bright people. And not longer so, right? At the end of the day, we believe that investing is something that any Jamaican can do, any human being can do, because we know we're not only talking to Jamaicans tonight, we're not only having a Jamaican audience, we have an international audience. Hey, Christine. Hey, Nicolette Richardo, MVP, here almost every week. Hey, what's up? And we believe that virtually everybody, just about, and you'll hear more about that a little bit later, can invest if they'd like to. And folks, that is actually the reason why JMMB was founded. For those of you who may not know, JMMB was co-founded by a wonderful Jamaican woman, the late Joan Isabel Duncan, and that was a huge part of her vision, was to create an investment company, a financial institution that the average everyday Jamaican citizen could walk into with a few $100s in their pocket to invest. And that's how JMMB began, people, because at a time when the money market was really only accessible to institutional clients and financial institutions, JMMB made it accessible to the everyday Jamaican all they needed was a few $100s to start. And we've never changed that vision. I still hear some people think that JMMB is for money people, and I'm like, that's so inconsistent with how we started. We are here for every Jamaican who has a goal and wants to achieve their goal, right? So we are happy to see you guys. Hey, Shauna. Hey, Denise. Hey, Ingrid. I love to see new faces, and I love to see our regular faces every week. Yes, Raquel, with $1,000. That's how it is. So JMMB is here for everybody, and we are going to, again, break it all the way down. Investing 101. We're going to be talking about what is investing, the different types of investments, how do you get ready to invest, and of course, to answer the question whether investments are right for you or not. So if you have a financial goal, and I think almost every goal in life is kind of financial, one way or the other, you need to be a part of this conversation. And tonight we have an awesome guest. We have one of our team leaders in our network of branches who is here to break it down for us. Again, I'm never the expert, guys. I'm just here to moderate the conversation and keep it going. But we have an awesome expert who is here with us, and she is the team leader for client partnership for the investments team in our Knutsford Boulevard branch. If we have any Knutsford Boulevard clients in the house. Hey, Alwyn, how you doing? How everything? We have the Nutsford clients in the house. If you're a Nutsford client, just say hey, because we are gonna bring her up right now. She is Nadine Thomas. Hey, Nadine.
Hi, Carrie. Good evening. Good evening, or to our guest, and thank you for having me.
Oh, we are happy to have you here, Nadine, and thanks. Of course, we know that we're still under curfew, so we know you don't really have anywhere else to go, probably, but
Certainly not.
we're happy that you chose to be a part of tonight's live because we know you have some awesome information. You have some awesome information to share. So, Nadine, let us jump right into it. Guys, we're ready? We're ready? Yes, I see it. I see it. Yes, Christopher. We are ready. So, let's go. So, Nadine, let's break it down now because what I find, right, is that people tend to mix up the word investing and saving, right? So some people say I save with JMMB and think it's the same thing as investing with JMMB. And you could probably save with JMMB, but could you start out, Nadine, by telling us what is investing and if and how it's different from saving? Let's start there.
Right. All right. Thanks, Carrie. So the important thing is that most persons understand what saving is, and from a tender age, most of us would have been given a piggy bank as a child to put away some funds. So that's pretty much what saving represents, putting away money for some future goal or some future objective. Now, where it gets interesting is how we differentiate between what we understand savings to be and what investment is. Now, when we start to talk about savings, we're looking at some form of short-term goal, some form of short-term objective. For instance, we're talking about our emergency funds, our rainy day money. And I think by now, most of us would understand what it means when we talk about our emergency funds. Certainly, we will talk more about that a little bit later on. But when we're talking about putting away savings and putting away funds for emergencies, one of the important characteristics to note is that these monies are put away in low-risk investments. So you're not going to be exposing these funds to any risk. One, the other important factor is that you want these funds to be accessible. They should be easily converted to cash. And it represents exactly what the name states, emergency. So if something comes up, you need to be able to run to an institution or run online. In this age where technology is so rampant, you can run online and execute a transaction and you have your funds available. So that's savings. So just to reiterate, we're looking at low risk and we need accessibility. Now, in addition to that, we'll find that when it comes on to saving funds and savings account and savings deposit, we're looking at low interest bearing investments. So I see I use the term investment there. But when we're looking at actual investing now, we sort of flip the script a little bit now and we're looking more medium to long term. So investing primarily relate to long-term investments, and you touched on it earlier, wherein investors or individuals may have long-term goals, long-term objectives that they would like to accomplish in the future. So when we start to invest monies now, we're looking at putting away those funds for a longer term into the future to meet those investment objectives that we have. So we spoke about savings, that these are at low risk investment and these are accessible. When it comes on to investing now, we're looking at being able to generate that higher level of return in order to help us in meeting those long-term objectives that we have. What many of us would know is that when it comes on to earning greater levels of return, then that is generally accompanied by greater levels of risk. So the primary difference is, Kerry, we're talking about savings, short-term, low risk, low returns, accessibility. However, when we start to look at investing now, We're looking at the long term to get greater returns, but that is oftentimes accompanied by a greater level of risk than you would have experienced in relation to savings.
Thanks, Nadine. Thanks for breaking that down. So again, guys, hey, we love to see more people joining the live. Hey, Odian, Christine. Hey, Fornia, Richardo. Love to see you guys. So let's just break that down again. And I love that, Nadine. So saving, so you have saving and investing. So saving, Nadine, as you said, is for anyone who is needing some funds, in the short term. So you need funds in an emergency or for an emergency, you put that in a savings type of instrument account. And it's also lower risk. And just to let folks know that savings with a deposit taking institution like a bank, you tend to have what they call deposit insurance, right? Insured by the Jamaica Deposit Insurance Corporation. I think it's up to $600,000 you can claim back that, God forbid, anything were to happen to the institution, you have that cushion of deposit insurance there. On the investing side, it's more for the medium to long term, but as you said, you would likely earn more on an investment, but it's also more risky to invest, and you don't have the cushion for deposit insurance. So that's the main difference, guys, and I hope you're picking that up, because then the obvious next question is, Nadine, how do I know that investing is right for me? Because now that I'm listening to it, I kind of like the deposit insurance piece, I don't know if I must pick up on this investing thing and take on more risk. I mean, how do I know that investing is right for me? And is investing really for everybody or not?
All right. So, Kerry, you see, I'm a person who believes that people need to dream big. We need to have big dreams. We should not limit our expectations and our goals. And naturally, as human beings, we believe we have an insatiable appetite for greatness. And that is the premise on which JMMB was founded. So deep down, as humans, we all want the best that life has to offer. We want to be successful. So yes, I will say investment is for everyone, but there are certain caveats, of course, that is associated with that. And so there are some primary things that we need to understand before we determine if investments at any particular time is really right for me. And one of the primary things we need to consider is, where along the financial life cycle am I? So I'll just include that there are different stages of what we term the financial life cycle. We're looking at accumulation of wealth. We're looking at growing and managing your wealth. We're looking at protecting your wealth. And of course, when you get into retirement or later down into retirement, persons may look at transferring their wealth. So naturally, if we're looking at perhaps somebody who is just entering the phase of accumulating wealth, for instance, somebody who is just a recent graduate, somebody who is just leaving university, at that stage in that individual's life cycle, they may not be experiencing the level of financial independence required to start investing. So there are certain basic things that you want to ensure that you account for before you start investing. The first thing is you want to be able to create a personal budget. And in this process, you're able to assess what your income is versus your expenses. The primary aim of that, of course, is either to create a balance, that is balancing your income with your expenses. But ideally, when we start to look at the purpose of savings and investing, ideally you'd want to be creating some form of surplus. In this case, it means that your income should exceed what your expenses are. So it's important to put things into perspective by creating a personal budget, and this will help us to identify behaviors that we may need to curb before we look at investing. So for instance...
Sorry, Nadine. Sorry, I just want to take a pause there because I'm seeing a question coming up in the live. Hey, Boogie. Thanks for joining. Because earlier you spoke about emergency savings, and I know that because we're moving quickly into consider what are the things we should consider before investing. Right. But I wanted to just take a pause because you mentioned about having your emergency savings in place. And I think that's certainly something that we talk about a lot, that before you start investing, you really need to have that emergency fund in place. And Boogie had a great question in terms of how much emergency savings should I have in place before I even start to consider investing.
So Carrie, you touched on a very good point, because that is exactly the next point I was about to raise. Right, so you're right on track with me. So having done the budget, you need to put your emergency funds in place. And we spoke about that earlier. I mean, life is full of unforeseen events. COVID-19, for example, is one of those events. Who would have anticipated COVID-19, and who would have anticipated that it would have impacted us, not from a health perspective only, but also from a financial perspective. So we want to ensure that we have our emergency funds in place. And this generally refers to about 3 to 6 months of living expenses, or you can say 3 to 6 months income. Now, as it relates to perhaps persons who do not have a steady job, then that individual may want to look at a longer time period of perhaps up to a year. So emergency funding is important. We want to ensure that we have at least 3 to 6 months of expenses or income in place.
Thank you so much, Nadine. So just to recap then, before we move on, in terms of the things we need to consider when investing, we have our emergency fund in place and have your personal budget in place. And in doing so, making sure that we are making whatever adjustments we need to make, either on the expense side or on the income side, that we have that surplus there so that we can start to invest on a regular basis to make sure that we're on the path to achieving our financial goals. But Nadine, what are the benefits of investing? Why should I even invest at all?
All right, so Carrie, before I go to that question, I want to also ensure that clients understand that we are never to invest our emergency funds. All right, because sometimes we get tempted by the fact that these funds have been there for a year, for 2 years, and nothing has happened.
Yeah.
And we are tempted to put it into something that is long term. So I just want to caution our listeners, never invest your emergency funds. It's there for a purpose. It is there for an emergency, and we want to be able to access it whenever that emergency comes up. All right.
So thank you.
Yes, Carrie. So your next question, Carrie, remind me
about the benefits, right? So we just wanted to give folks a sense of what are the benefits of investing, either in the long term or the not so long term.
All right. So some of the benefits of investing, we in terms of the short term, we're looking at greater flexibility, of course, because we mentioned that those funds will be accessible to you. Over the short term, of course, we're looking at lower risk. But now when we start to look at long-term investing, we find that long-term investing helps to smooth out market bumps or volatility, as most of us would understand volatility to be. So that is the ups and the downs in the market. So investing over the long term smooths out any volatility that we may experience. Of course, it also gives our funds time to grow. You've worked hard for these funds. You want to maximize on the returns that are possible from these funds. So investing, and remember, we speak to investing being long-term, investing will definitely facilitate that sort of growth in your funds and on your portfolio. It also allows for compounding. That is earning more money on your money, and who doesn't want to earn more money on their monies? In addition to that, when we start talking about investing and investing for the long term, you find that there is an obvious reduction in perhaps trading fees, especially if we start to look at stocks, and we will touch on that a little bit later. But you find that investing over a long period of time, when it is that you're not in and out of the market on a frequent basis, that seeks to reduce trading fees that you may incur, and of course facilitates greater portion of your funds towards your capital. And the last point I want to add, Kerry, which is very important, the emotional aspect of it. Now, for me, peace of mind is a big thing. I value peace of mind. And I'd want to think also that many of our investors value peace of mind. Now, investing over the long term facilitates that peace of mind. You don't have to be so concerned about the ups and the downs of the market, because you would have set an objective for yourself and you would understand that there will be volatility, but over the long term, for instance, your portfolio would experience the growth, the expected growth that you possibly desire, while at the same time reducing the risk that is associated with investing in general.
Thanks so much for that, Nadine. And, I'm loving these comments, guys, because as Nadine mentioned, we're going to go into the different types of investments and so on. And I think those benefits, just to recap some of them, of course, the longer you invest, it tends to augur better for the type of return that you're likely to receive and so on. But question though, Nadine, because we keep talking about long-term and short-term, and I saw the comments coming up in the live comments stream here. When you say short-term and long-term, what's the time horizon you're looking at? Like, how long is short-term and how long is long-term?
Okay, thanks, Kerry. So when we talk about short-term, we're talking about any period up to a year, right? That's really short-term. When we start to talk about long-term, and let me touch on medium-term, would perhaps extend up to about a 3-year period. But when we start to talk about long-term, we're looking at periods 5 years and longer.
Okay, so 5 years and longer is long-term, and then up to a year is short, and then medium is 1 to 5.
Thereabouts. You got it.
Thank you. I saw a question come up here. I don't remember who said it. Somebody, I think it was Richardo, asking about, can't we use our credit card as a means of emergency funds? Richardo, you're pulling our leg because you watch us every week, and don't go so. But it's all good. No, I mean, guys, what we're advocating, obviously, is you're saving up your emergency fund. Yes, obviously, if there is a jam in a particular situation, like you have to go to certain hospitals late at night, and you will have to swipe that credit card to actually get through the door. But the reality is, again, folks, we're not asking you to use your credit card and incur a 40% interest rate in an emergency. You need to have that savings there. So even if you have to swipe your card in the late night to access an emergency service, you should have the savings there to pay it back relatively quickly. So just to be clear on that. But thanks for the question, Richardo. So great. So Nadine, so we spoke about investing. What is the difference between investing and saving? We asked about, what should we consider, whether and when and before we invest, and what are the benefits of investing. But again, we're getting the comments here. There are tons of different kinds of investments. I see people talking. We have some nice, astute investors. We hear stocks here, unit trust / mutual funds. Could you just kind of give us a general overview of the different kinds of investments that are available that I can invest in?
Okay, certainly, Kerry. All right. So traditionally, and in respect of the Jamaican market, most of us would be familiar with stocks and bonds, right? In addition to those, we can look at other asset classes, and generally stocks and bonds are classified as equities and fixed income, respectively. Now, there are other types of investment alternatives that are available. For instance, real estate has been able to provide additional upside to investors' portfolio. But in terms of the investments that we would really be familiar with, we're looking at stocks, we're looking at bonds, we're looking at real estate, and then those securities can then be allocated into unit trust products, or packaged rather into unit trust products. So instead of investing directly in a stock or directly investing in a bond, for instance, an investor can opt to participate in a fund, which in this case could possibly be a unit trust fund, perhaps made up of stocks. It could possibly be a unit trust fund made up of bonds, or it could be a unit trust fund, which is a combination of the different asset classes that we mentioned earlier.
Okay, Nadine, break down for us what is a unit trust exactly, because I know that it's a popular term that a lot of people may hear being thrown around, and they hear it's a good thing, especially if you're the kind of investor who doesn't want to be monitoring the markets every day and knowing when to come in, when to come out. What is a unit trust? Is it the same as a mutual fund, and how does it work?
Right. So a unit trust is similar to a mutual fund. In terms of the basics, any difference would be the background as to what happens in terms of the structure. Where in a mutual fund, maybe a company, for instance, that offer funds, for instance. Now, unit trust in terms of a simple definition for unit trust, it would be a situation in which investors' funds are pooled together, and the fund itself is managed by a portfolio manager who then invest these pooled funds. So my money, Kerry, your money, Richardo's money, all these funds are pooled together and then invested in different assets, which are then managed by the portfolio manager. Does that answer the question for you, Kerry?
Yes, I think so. And when we talk about like unit trust prices, because I look in the newspaper and I see these different prices, buying and selling. I mean, is it that I get a certain interest rate when I invest in a unit trust, just to be clear?
All right. So you spoke about unit trust prices, and to use the financial term that we generally associate with unit trust prices is to determine the net asset value of the portfolio per unit, net asset value per unit. So the price that you're looking at would represent what the value of the fund is on any particular day. Now you ask the question as to whether you get an interest rate. If it is that you were to look at how the information is presented in the paper, as you mentioned, you would see that it doesn't state an interest rate. So a rate is not quoted, but what it may indicate is that the returns that the portfolio or the fund or the unit trust would have experienced over a 1-year period or a 5-year period. And I say that in particular, that it is shown perhaps in a 1-year period or a 5-year period to indicate that these funds oftentimes are not short-term, right? So they are long-term. So the returns are quoted on a medium to long-term basis.
Okay, great. Thanks for that. Nadine, you have a hell of a fan club in here, just saying Team Nutsford is represented in the house tonight. Welcome, guys. So great. Thanks for that clarification, Nadine, because, there are quite a few questions coming up. And I just want to acknowledge that we are getting a couple of questions from folks, who want to know how they can get started with JMMB, how can they start investing with JMMB, and also someone overseas asking about investment opportunities with JMMB. So guys, feel free to DM us right here in our social media platform. Send us a DM, give us your contact information, and we will have someone contact you, because at the end of the day, if it is that you have those questions, you really need to have a nice one-on-one, what we call financial planning conversation, so we can get an understanding of your current situation and we can guide you accordingly. Okay, guys? So just to acknowledge, if you have that specific need to speak with someone, you can just DM us and we'll support you with that once we open for business again tomorrow. Not tonight, people, just saying. It's soon bedtime. But yeah, thanks for that, Nadine. So great. So we looked at a few different types of investing. You spoke about stocks and bonds. We covered unit trust. There are also options like investing in real estate. I know we'll get a whoop whoop from Boogie on that. I think the other question then is, Nadine, how do I start investing if I don't have a lot of money? Because let's just keep it real. Most of us, we don't got a bag of money. We're not sitting on a load of cash, right? So let's just keep it real. So I don't have much money. How do I start investing exactly if all I have is a couple $1,000 here to get started?
All right. Oh, I think, okay, yes. All right. So, I mean, we have just a few dollars. But we would have created our emergency funds, and we want to now start looking at the long term. We want to now to start looking at accomplishing that house. We want now to start looking at accomplishing that car, for instance, or a child's education, or we want to be saving towards retirement. My advice is just get started. If you want to start, get started. Now, the bottom line is that you may not, well, let me put it another way. As it relates to perhaps unit trust funds, generally the minimum amount to invest in these funds are fairly affordable. However, if it's a situation where you find that you have not yet accumulated sufficient funds to start the actual investment based on the requirements of whatever investment that your advisor would have agreed with you is appropriate based on your risk tolerance and your goals, then you want to perhaps start saving in a low risk account to accumulate those funds to then start investing. So I said there are a lot of options available. If it is that stocks are determined to be best suited for you, the great thing is that the stock exchange has reduced the minimum unit purchase or the volume purchase to 1 unit on the stock exchange. And this is available through the online platform of most companies. For JMMB, it would be available through Moneyline. So you can place your orders through Moneyline. We also advise that you speak to a financial advisor before you get started. If it is that you are not so confident and you're a little bit risk averse and you don't want to delve deeply into any particular type of investment or any particular asset class, then you can look at the unit trust funds. For several unit trusts, the minimum purchase amount might be about 200 units, which could perhaps amount to about less than $5,000. So that's really a great place to start. But as I said earlier, if it's a situation where you have not yet accumulated sufficient funds, then you can start in a low risk instrument. You can start in a savings account and accumulate the funds to then transition into the investments that are best suited for you.
Thanks, Nadine. Thanks for that. And again, I just want to acknowledge some excellent questions and comments coming into the live. Hey, Natasha from Montego Bay, tonight is bookcase night. Natasha watches us every week and she tells us what she's doing. 1 week it was a mani-pedi. Another week it was a facial mask. Last week it was a handbag, right, Natasha? And tonight is a bookcase. Thank you for tuning in. And Tamayo, we thank you for the feedback as well. Tamayo is a happy JMMB client. And Tamayo, I hope you're telling your colleagues and your friends to tune in and join us on these lives. We'd love to have you. So just to level set, then Nadine, before we transition into the next set of questions. So for those, especially for those joining us, so first up, we need to start out with making sure we have our emergency savings fund in place, which is the equivalent to maybe about 6 months worth of expenses, right? Saved up in a nice savings account or some short-term accessible account or account or instrument that you can grab in a hurry.
Yes.
Do up your personal budget, making sure that your income exceeds your expenses. Once you have the emergency savings account, make sure you have that surplus so you can start investing. And as Nadine rightly said, guys, just get start it. Even if it's with a few $1,000s, we can just get started, and you don't need to feel the need to jump into like the stock market right away or anything like that. There are things like unit trust funds that you don't need a lot of money to get started in, and you just put your money in a unit trust fund. The portfolio manager takes everybody's pooled funds and manages it by purchasing the different assets that back the unit trust funds, whether it be real estate or stocks or bonds, and he or she takes care of that, and you kind of just sit back and watch your money grow over time. That is, again, for those people who don't want to delve into certain instruments directly, like the stock market. You may find it intimidating. And of course, know what kind of risk you want to take on, as Nadine would have said. So if you don't want to take on a lot of risk, again, there are different types of investment instruments that, according to how much risk you want to take, then you make that decision as well in consultation with your financial advisor. But, Nadine, next question, because you spoke about, investing is really something you need to do for the medium to long term. But if I'm the kind of person that I want to turn over my money quickly, right? A lot of us don't have the patience. I'm just saying. I don't want to turn it over quickly. Do I invest it? If so, what do I invest it in? Is there such a thing like that? Because you hear of a lot of investment type opportunities going around, and I don't know.
Mm-hmm. Mm-hmm. Yes, Kerry. So this is where it gets a little bit interesting now, because persons would have gained knowledge about opportunities that can facilitate fast growth or quick growth. Sometimes we caution clients to be careful of those and do thorough investigation so you understand what the nature of the investment is. So you pointed out that you have some funds and you want to earn some quick returns. My caution to clients: never invest your short-term funds in long-term investments. And I can point specifically to some information that was shared with me recently. A client indicated that she had her daughter's school fee. It has to be paid in about September, but she felt that she wanted to maximize on those funds, so she bought IPO. All right, so most of us would be familiar with what is happening in the market now and how the impact of COVID has been reflected on the stock market. So just picture that. The fact is that she has a short-term objective. She wanted to make some quick money, so she took a long-term risk. It really doesn't work. And what we refer to that is market timing. So the reality is that you're going to invest short-term funds in risky assets. You're going to invest short-term funds in long-term assets. The possibility is that you can get significant returns, which we have seen people experience while the market was in a boom. However, the opposite is also quite true, because while we can get a possible return, there is no probability as to where the market, what direction the market will take. So similarly to how the market stock prices would have gone up, the possibility is that the market could plunge as well. And that is something that we might not be able to anticipate. So there is a possibility of earning that short-term return on risky assets, but you have to bear in mind the risk that you face, because these are long-term instruments that are very volatile, and it is quite unpredictable to determine what the shifts or the possible shifts or the levels of those shifts might be in the future.
Thanks for that clarification, Nadine. And, as you're responding, I see Alfred here from Facebook with a question, which a lot of people tend to ask, what's the best return I can get on X amount of US dollars? And the reality is, even in a discussion like this, there's so many different types of investment opportunities. Again, in most, if not all the instances, there's no guarantee. There's really no guarantee. So if anybody's quoting you an interest rate, be very careful, because anything can happen. And also, to even begin to look at what options you can look at, again, it depends on who you are, how much risk you want to take on, how long you want to put away the money for. There are so many questions. So again, it's so important to have that discussion with your financial advisor. And again, I saw another great question here. Someone saying, boy, I'm investing, but I'm not even sure what I'm investing in. Hold on your financial advisor, have the conversation, whether it's JMMB or not. We believe in accountability. Have the conversation and make sure that you're clear about what you're investing your money in. And if there's anything you're uncomfortable with, please, guys, raise it. No problem in that. It's your money.
Right, Carrie. So it's very important. Sometimes we get caught up in what's happening in the market, and it's very exciting, and your friend made that kind of return from that product because they invested at a particular time. It does not mean that perhaps because we have the same overall investment objective, it does not mean that we are going to accomplish that objective by taking the same path, because or circumstances, for instance, might be different. The timing at which we get exposed to these instruments might be different. And as we know, time is money. Yes. And so that may have a significant impact on the overall returns or the overall results that you experience from your portfolio. Another thing I want to add, Kerry, is that this whole aspect of speculating and this whole aspect of market timing requires a lot of attention. It requires a lot of attention, and the reality is most of us as investors do not necessarily have that time to devote to watching the market and making predictions as to what direction we possibly think the market could go in. So that's a major risk there, because we do not have the time to devote to applying the strategy of market timing.
Absolutely. And I thank you for that nugget, because, again, that's what a lot of, and it's so unfortunate, that story that you shared. Someone has their child's school fee and they're hoping that they can time the market by putting in the money in an IPO, hoping to get a quick gain, and it just did not happen. It's so very important to make sure that there's a disciplined approach, an informed approach. And that leads me to the next question, Nadine, because we talk about a portfolio of investments a lot, and I know that even at JMMB we have different types of, portfolio investments. We tend to call them goal plans. So some people may know about the JMMB Wealth Builder or the JMMB Graduate and so on. What exactly is a portfolio and this portfolio approach to investing, and how does it work exactly, and what are the benefits associated with it?
All right. So a portfolio is really a group of assets providing exposure to different classes of assets. What that does, Kerry, is that it seeks to, one, maximize returns for an investor. But in addition to that, risk is often a great concern for investors. And so what portfolio investing does, and having that balanced approach to portfolio investing, what it seeks to do is to diversify or mitigate the risk that would be faced by an investor. So let me break that down for you. So for instance, you perhaps would have invested all your funds in one asset class. And remember, we spoke about the different asset classes being fixed income, equity, and we have alternative investment, which could perhaps relate to real estate. Think about the fact that you invested all your funds, you have $100,000, and all of that is invested in one stock. And we see what has happened over the last couple of weeks with COVID and the stock market. It therefore means that the stock you've invested in would have had significant negative impacts based on the movement in the market. Now, what portfolio investing does is it allocates that same $100,000 over different classes of asset. And what that seeks to do is to reduce the overall impact that each class of asset would have to the event. In this case, we're talking about COVID-19. It seeks to reduce the overall impact on your funds when those funds are invested across different asset classes. So your returns potentially will be less impacted on the negative side rather than it would have been had you invested all those funds in stock. Now, in taking a portfolio approach, it requires certain characteristics. And we want to say, we spoke about having clear objectives. It's important that as investors, we have clear objectives as to what it is that we're trying to accomplish. In addition to that, those objectives must be based on some solid investment philosophy. And most institutions, JMMB in particular, we base our investment philosophy on fundamentals of the company. And oftentimes we'll hear persons talk about the whole concept of fundamental analysis. So whatever assets that we are including in that portfolio would be based on thorough and diligent research that is based on the fundamentals of the company. So we're looking at the company in respect of its management capabilities. We're looking at its intrinsic value. We're looking at its profit margins and how it performs in its industry. So it's a holistic analysis that is done when we start to look at portfolio investing to ensure that we select the right assets that will help our investors to realize their portfolio, their goals rather. What is also interesting, Kerry, that I must point out is that portfolio investing requires consistent monitoring and periodic rebalancing. And I'm emphasizing these things to ensure that our listeners or clients understand the importance and the work that goes into ensuring that we select the right assets for the portfolios that are designed to get investors towards their goal. In addition to the factors that I mentioned, diligent research, fundamental analysis, consistent monitoring, rebalancing, there is general oversight as it relates to how these portfolios are managed. So oftentimes there's an oversight committee at the respective institution which looks at what it is that the portfolio managers are doing to ensure that the assets, for instance, the risk that is involved in the asset selection is consistent with the investment philosophy and the overall objectives of investors in this case.
Thanks for that clarification, Nadine, because I mean, and this is probably because I work with JMMB, probably not, but even as an investor, I think it's comforting to share this kind of information because, again, when people think of investing and they think, okay, well, I need to buy some stocks on the Jamaica Stock Exchange or whichever stock exchange, or I need to buy this particular kind of bond. And that can be daunting because, again, it takes a lot of research, it takes a lot of time, and there's nothing wrong with that if you're prepared and able to invest the amount of energy behind doing that sort of direct investing. But what you're saying in the case of portfolio investing along the lines of like a JMMB Wealth Builder or similar kind of product is that you're kind of the investment company is taking the legwork away from you by saying, look, I will take your money and I'm going to invest your portfolio in a bundle of different types of investments. based on your risk appetite, of course, and how long you want to invest for. And the investment manager is going to be the one to do all the legwork. As you said, the research, the due diligence, knowing when to buy, knowing when to sell. And you really kind of just sit and benefit from what is likely to be growth in your portfolio over time, is basically what you're saying.
Exactly, Kerry. So all our investors are doing, or all we're doing as investors, we're just monitoring. We get our statements, we check to ensure that everything is in line. For instance, we stick to our goal and ensure that if it is that we committed to ourselves, because it's not anybody else that we're committing to, Kerry. It's our goal. We have to own it. We're committing to ourselves that we're saving towards this goal. We're investing towards this goal. We stick to the goal. So if we say that we're going to invest $10 per month, regardless of what is happening, try and ensure that you stick to it. Ensure that you invest that $10 per month, because at the end of the investment cycle, at the end of the time horizon, who benefits from it? You do.
Exactly.
That's all you need to do. Stick to your goal and monitor your reports, your statements. That's all. And all the other work is done by the investment advisor and the team supported.
Correct. And I would love to, just acknowledge what you said, which kind of correlates to what we said actually several Goal Getter live streams ago, guys. And if you go onto our YouTube channel, JMMB Group on YouTube, you'll see a library of all the lives we would have done. And perhaps our second live ever, we spoke about keeping your investments on track during COVID-19, which is a great watch. But also it was a similar message that Greg and Peter would have shared with us at the time. And the thing is, even in spite of COVID, stay invested. Keep investing. Keep investing your money. I mean, I know I see some COVID-related questions coming up, which we're going to go into in a little bit later on down in this session. But I think the salient advice that you gave, Nadine, is that we need to keep investing, keep on track with our investments. And the reality is that if you prefer to take a portfolio approach where you facilitate an investment manager managing your funds for you to take that heavy lifting off of you because either you don't have the time or the know-how to do it, then that actually could be an option for you. Is there a fee associated with that kind of service, Nadine? It's a question I'm seeing in the live.
Certainly, there's generally a fee. I mean, naturally, there's a lot of work that goes into this, but there's generally a small fee. The fee is generally charged perhaps on an annual basis. So perhaps in statements, clients may see just a tracking or an indication as to perhaps how much fees would have been accumulated thus far. And the fees are oftentimes charged on the value of the portfolio. Small fee, as I indicated earlier. But in spite of the fee, what I want to emphasize is that the benefits that are gained from investing in portfolio far outweighs whatever costs are involved. I also want to add, Kerry, that when we talk about portfolio, we're not talking about a one size fit all kind of thing. We're talking about, and let me just backtrack a little bit, talking about identifying your goal or your goals with your financial advisor, identifying certain characteristics, your risk tolerance, your time horizon. And in that partnership, your financial advisor will be creating a tailored portfolio that suits those goals. So we didn't talk about the types of risk tolerance, which could be conservative or moderate or aggressive. But I just want to add now that based on your tolerance for risk, your portfolio advisor will be creating a portfolio that suits your risk appetite and which is geared towards helping you to realize your investment objectives. So both goes hand in hand.
I love that. And I love that clarification because, again, it's a very personal thing. That's what investing is. There's really no one size fit all, and having that conversation with an advisor, and the advisor again getting to know your goals, how long you want to invest for, how much risk you want to take on, will make the recommendation and portfolio, as it were, allocation or assignment that's right for you, essentially. And I do like that, and I do appreciate that. It's really great to see the engagement, guys. I'm actually seeing a lot of interest in the stock market, and we love to get feedback because it informs the kind of topics that we can do in future lives. So we have a lot of stock market enthusiasts here. But Nadine, I know there's a question that we had discussed before we came on, as we were preparing to come on, about different types of investment terms that I need to be aware of. I mean, are there any popular, people have this kind of nomenclature or jargon that they throw around when they talk about investing. Are there any popular terms that I need to know about?
Certainly, there are some basic terms that we come across from time to time, which I think is really important that we know and we understand. We talk about time value of money is one, and this relates to the whole concept that money today is worth more than money in the future. So if someone, for instance, were to make you an offer and to say, okay, Kerry, I can either give you $100,000 today, or I can give you $10,000 every month going forward. I'm certain that your first option would be to give me that $100,000 today, because then you're thinking that I could take that $100,000 and I could then invest it in something that can generate added return. So that's pretty much what we're talking about when we refer to time value of money. Money today is worth much more than money in the future, because it allows you to be able to invest it to increase the overall value of the funds you have. Another term that I think we'd want to touch on is unrealized returns. And unrealized returns could be in respect of profit or loss. So we may see unrealized profits on our equity statement. We may see unrealized loss. What this refers to is gains or losses that are on paper, right? So you would have bought a stock. You would have bought NCB, for instance, at $100, and they're now trading at $155. Then you would have made in this case, you would have made an unrealized gain because you have not yet crystallized your returns. You have not yet sold the stock to actually realize those gains. And in respect of a loss, it would be similar. So the stock price would have declined from, for instance, what you bought it at. If it is that you still hold those assets in your portfolio, they're not yet sold, then they're referred to as unrealized. Until you sell, then you would not have realized the returns on the asset. We also can touch on the whole concept of volatility. I mean, in recent times, we've been hearing that, the stock market is very volatile. In this time of COVID crisis, the market is very volatile and unpredictable. The whole concept of unpredictability is really what it refers to. So there's rapid and unpredictable changes in the market, and perhaps this period that we have experienced would have been a typical example of what we speak to when we talk about volatility. So there are lots of ups and downs in the market that we can't necessarily predict. Another concept that I can also touch on is the whole concept of, expected return. And outside of talking about the mathematical sense, it is really a profit or loss that an investor anticipates on their investment. So I raise that point, Kerry, because so often persons, and as we spoke about market timing earlier, investors perhaps would have bought a stock, the stock accumulated to generating an unrealized return of say 30%, 40%, 50%, but we still hold those stocks in our portfolio. Now, the guide to purchasing stocks, for instance, is to initially set an expected return for yourself. So once you meet that expected return, the advice is to sell and rebalance your funds. It's not advisable to sit with a 50% gain, for instance, in unrealized in your portfolio. It's advisable then you would have experienced your expected return and set a realistic expected return. You would have realized your come to a point of realizing your expected return. So it's advisable to take the gains and perhaps reposition in another asset or in another stock. So I think those are some of the general points that we would generally come across and the associated definitions.
Thank you so much, Nadine. Question, I don't know if we covered it earlier. And we probably did, because not a lot of people know. Well, first of all, when we talk about equities is the same thing as stocks, right? That's another popular term that is thrown around. And then we also talk about bonds. What is a stock and what is a bond?
All right. So when we begin to talk about stocks, stocks represent ownership in a company. So pretty much the company would have, most of us by now would be familiar with IPOs. The company would decide to offer a portion of the company to the general market by dividing that portion of the company into units. So as an investor buying into a company, buying into stocks, you are becoming part owner of the company. Now, there are different types of stock, or there are two different types of stocks. There's ordinary stocks, or we say ordinary shares, and there are also preference shares. Now, the difference with the two is that preference shares generally offer some form of guarantee in terms of return. In the event, God forbid, that particular company is wound up, then preference shareholders, as the name suggests, would get preference over ordinary shareholders in retrieving their investment. As it relates to ordinary shares, there are no guarantees for returns. Ordinary shareholders are allocated returns dependent on the company's profitability. So if the company makes a return, for instance, they make profit and they decide to pay a portion of those profits to holders of the stock, holders of the ordinary stock, then those payments would be made by means of dividend payments. But generally speaking, ordinary shares are generates a greater level of risk than preference share, and ideally a greater potential return than preference shares do. When we start to talk about bonds can generally be described in its simplest sense as a loan, and these are often offered by sovereigns, different countries. So some of us would be familiar with the different government of Jamaica bonds that are available in the market. How these instruments are generally structured, they are oftentimes long-term and they guarantee a specific return, which perhaps is paid maybe on a quarterly basis or a semi-annual basis. We generally refer to those interest payments as coupon payments. So persons may have come across the whole concept of coupon. The bonds at issue would generally stipulate what the coupon payments associated with that particular bond is. I must also add, Kerry, that there's also perhaps corporate bonds. Some person may refer to them as corporate papers. These are instruments that can be offered by a company or an institution. So bonds are not necessarily offered by just a government, but companies can also offer those interest-bearing instruments.
Thank you so much for that clarification, Nadine, because I mean, I know those are popular terms as well, investment terms that people use, but what I think your description or explanation of them does is that, again, it brings home the point. A couple of things for me, certainly, is that, first of all, it reminds us again how risky investing can be. So when I buy shares in a company, again, God forbid, it's not only about whether the company gets wound up or not. That's a whole other extreme. But even in terms of the movement of the stock prices, of the price of the stock, of that particular stock on the exchange, when I bought it versus when I'm able to sell it, that determines how much return I get and when. Bond holdings as well. I mean, I do get a guaranteed return, or they tell you how much they're going to pay you, and you get those coupon payments at certain intervals.
Right.
But again, we've seen instances even very recently, without calling any names, where there are some companies that are even sovereigns that issue bonds, like Venezuela. Let's just talk about it. Venezuela recently would have suffered tremendously, and they're still struggling as an economy. And those bondholders were basically almost left not really earning anything, And it goes back, I think, to the point about portfolio investing versus an investor going straight dead on into investing in stocks, into investing in bonds directly on their own, or particular bonds and particular stocks, which again is a choice that they have, and we're not taking away that choice from people. But if you are an investor, and again, you don't have the time, you don't have the knowledge to be continually monitoring the stock market and monitoring the company performance and whether or not this bond is ratings and all these things, if you can just take your money and put it in a portfolio and invest it and have the investment manager do all that monitoring and all that legwork, it actually really could be a viable option.
Exactly. You touched on the very right point that I was about to raise, Gary.
Great. Awesome. So we are on the right. We're at 8. Odian, we probably need to have you as a guest on these lives. Odian is giving some great nuggets. And I just want to acknowledge Tamaya. Yes, we see you. We know you want us to come downtown. I can't tell you we have any immediate plans, especially in COVID-19, but we take your feedback and we thank you for that. And I think there's really an opportunity to delve further into the stock market conversation, guys. We thank you for your feedback. It's really awesome. It's really awesome. There's a question here about, is it TY from YouTube? If I buy a bond at a particular coupon rate, can the coupon rate decrease in the future? Is that possible, Nadine?
Oh, no. So the coupon rate, unless it's a variable rate instrument, but the coupon rate won't change. What we generally use to assess bonds is the yield to maturity. So the bond oftentimes would be issued at par, perhaps say $100. But once a bond is trading in the market, then it can trade in different directions. It can trade above par, above $100, or it can trade below par. And what that does, it would impact your overall returns, considering not just the coupon, but the price at which you would have bought the instrument at. So say, for instance, an investor who would have bought a bond issued at par, $100, the investor would have bought it at what we consider to be a premium at $110. Then it therefore means that they are paying at $10, an additional payment of $10 than what the bond was initially issued at. And what that in fact does is reduce the actual yield to maturity on that particular bond. If we're looking at the reverse, where the bond is bought at a discount, so you're paying $90 for something that is valued at $100, then that would seek to increase your yield to maturity. Because the fact is that you would have spent $90, but come maturity, once you hold it to maturity, you would be getting back an overall value of $100, meaning that that additional $10 would be added to your overall return. So that pushes up the overall yield. However, the coupon payment or the coupon on the bond doesn't change.
Thank you so much for that, Nadine. So I think we can wrap up this segment of the discussion. We're going to go into our next segment where we're going to give some specific attention to what's happening with COVID-19 and how we should be investing at this time. But just to let everybody know that even though this is a live session, it is being recorded, guys. And between tonight and tomorrow morning, it will be uploaded to JMMB's YouTube channel, on Twitter, Facebook, and Instagram. So even though we're not streaming to Instagram, you will be able to watch a recording on Instagram, guys. So feel free to go back, rewind, rewatch, bring in a friend or a loved one to watch with you. So anything you would have missed or didn't quite understand and want to just do a quick replay, we invite you to do that. But just to summarize again for everybody, in terms of what we've covered so far, is that so we start out by saying, look, there's a difference between saving and investing. If you're in this thing for the short term, not a lot of risk, then saving is for you. There's deposit insurance there for you to cover you just in case anything. But on the investing side, it's more for medium to long-term time horizon folks who have goals for anywhere between 1 to 5 and over 5 years for the medium to long-term.
Yes.
And you do have to take on some more risk because there's no deposit insurance on the investment side. Of course, before you start investing, if that is for you, you have to determine, again, not only how long you want to invest, how much risk you want to take on. Make sure you have that emergency savings fund in place, which is the equivalent of about 6 months worth of your expensive expenses saved and put aside in a nice, easily accessible savings account or short-term investment that you can access in a hurry. Sit down, do your budget, income versus expenses. Make sure you have that surplus. Have the conversation with a licensed financial advisor. Be clear about your goals. We'll work through how much money you need to save to buy that house, to acquire the car, to send your children to school, to retire, etc. And then having done that, you're going to get the assignment of, or recommendation rather, of what investments are right for you. And the big point, which I think is a great takeaway, is that as an investor, you can go in on your own, buy those stocks, buy those bonds directly on your own, or you can employ a portfolio type of approach where you invest in a portfolio, a fund, or for smaller investors, maybe even a unit trust, where a professional investment advisor, they just take your money as part of the fund and they invest it for you in a variety of different instruments, again, depending on your time horizon and how much risk you want to take. And that takes away the legwork and a lot of the stress, and that's an option as well. So I think we've kind of level set that. Nadine, am I missing anything?
You are right on the ball, Kerry, right on the ball.
Awesome. I can get the work. I can go work at what branch now. All right, awesome. And yes, Shar, whether you want to do bonds directly or stocks, Shar is asking, can I walk into JMMB and buy bonds? Yeah, so if you want to buy bonds directly, that can be facilitated. If you want to buy stocks directly, we are a licensed brokerage or a member of the Jamaica Stock Exchange. Yeah, we can do that for you. But if you want to do unit trusts, we have several unit trusts. We have different types of portfolios available. So whatever your style is, again, whatever your risk is, whatever your time horizon is, we got you. All right. So hit us up in our DMs. Slide into the DMs if you want to. That's another conversation. But Nadine, we're going to jump into now COVID-19 because that's the hot button question, right? Is now a good time to be investing, right? The stock market is down and I don't like how these prices are looking. And I don't know, should I be investing or should I kind of just keep it liquid? Someone earlier, I forget her name, Sharon was saying, let's just keep it liquid right now, free cash flow. What's your recommendation about investing during COVID right now? Because we're not out of COVID. Let's just keep it real. It's still
right. We're definitely not out of COVID, Kerry. But I'm gonna share an experience. And it is something that I would have shared with other colleagues of mine. I remember the 2008 financial crisis. I mean, I was really young in the industry at that time, but I remember in particular when we had the Jamaica debt exchanges in 2010, I had a client who, at the point in time when everybody was selling government of Jamaica bonds, he came into my office and he said, I want 200,000 worth of GOG 2039 bonds. I always use that as an example, Kerry. And he bought those bonds at $59. Now, that was the first time I really understood what it meant when persons talk about understanding the market, investing for the long term, and taking a risk or doing the opposite of what the market is doing. Because at that time, everybody was selling and he opted to buy at that very low price. Now, if we're to look at what the 2039 bond, the 2039 government of Jamaica bond is trading at today, it's at about $120. Now, Warren Buffett says $120, Kerry, and he bought those bonds at $59. He still has them, by the way, because he's now retired. Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. The point I want to drive home is that there is opportunity in every crisis, and this one is no different. So we would have seen, as somebody alluded to, the stock market has somewhat plummeted. Stock prices have somewhat decreased throughout the period. But we spoke about this earlier when we said, look at the fundamentals of the companies that you're investing in. And so we advise clients that now is an opportune time. There are certain good assets. There are certain very good stocks that are based on strong fundamentals that are now trading at discounted prices. So do not be fearful. There is an opportunity. However, what we advise is that you do it in a phase basis. So you have 200,000 to invest. Perhaps you want to stagger that, because we are still in a period of volatility. We're still in a period that is quite unpredictable, and you want to ensure that you're not necessarily buying these assets at the highest possible price. So you're gonna stagger that or that purchase rather. And the concept that we generally use is dollar cost averaging. So you're seeking to get that asset at different prices over time, possibly lower prices that will average down your overall cost of acquiring those stocks. So now is a good time to look at the stock market, but as we caution, you want to look at companies that are fundamentally strong. And research is currently going on. We continue to advise some of our clients. I mean, I'm not gonna indicate in this forum what are some of the stocks that you want to look at, but certainly we ask that you maintain consistent contact with your financial advisor who can help you to navigate the market. I also want to draw on the fact from a global perspective, if, for instance, we were to use the international market as a barometer, this S&P 500 index have corrected almost 30% of decline between February to now. So we see where a lot of the stocks on the US market have rebounded. So that's an indication also that the market is correcting itself. I mean, perhaps a week or 2 weeks ago may have been more ideal to get some of these assets that we're looking at, but certainly it is still not too late for us to participate in the market and acquire these companies that have strong fundamentals and include them in our portfolio. Or better yet, we can look at the portfolios. We can look at unit trusts if it is that we don't want to expose ourselves to any one or any particular asset. So, Carrie, the answer to your question in short is that yes, now is a good time to invest.
Now is a good time. So not because COVID is here upon us and things may not look too rosy as far as we're concerned with the stock market and so on. Now is a good time still to invest because you're saying there could be some possible bargains on the stock market. And I'm glad you said we're not giving stock tips on this particular live, because again, we're dealing with such a wide audience, people with different goals, different risk levels of tolerance, different time horizons. So to say, well, okay, Nadine say I should have bought XYZ stock before it got tight and it got down, that's not going to help anybody, because again, it's about what is best and right for you based on your goals and so on. But again, even if you are in a unit trust or in a portfolio type product, the point is still keep putting that money. Odian gave a great point, especially if your income was not impacted and by COVID, one of the fortunate ones, then keep investing. Or even if your income was impacted and you do have the opportunity to keep investing, please stay invested. Keep putting your money in your investment account, in your savings. If you had to tap into that emergency fund and you're now in a position to top it right back up, please do so. So I think that's the word here. Stay invested. They're still invested in the crisis. That's wonderful. Do you have any additional advice, Nadine, in terms of how do I invest in the COVID times where there's heightened uncertainty? I don't know if you have anything else additional you want to share on that note before.
All right. So certainly the whole COVID period would have taught us a lot. Certainly for some persons, it would help us to recognize the importance, as we said earlier, of having that emergency fund in place. But what I'd want to caution is that in this period, we don't want investors to become distracted. We don't want investors to lose sight as to why they invested in the first place. So as you rightfully said earlier, Kerry, if you have your portfolio which is existing, if you already have a well-diversified portfolio, then we want you to stick to your investment strategy and we want you to stay invested. For persons perhaps who may not have a well-diversified portfolio and want to capitalize on the opportunities that are now available, then of course, certainly you can have the discussion with your investment advisor. You can have the discussion with your financial advisor to identify what are some of the good bargains that are available now and what would be best suited for you based on your investment style.
Thanks, Nadine. And, I think we can just wrap this section now before we go into our final housekeeping matters and our final nugget. But again, a popular question that came up, and hey, Katie Blue from YouTube, asking about, how much money does she need to start, investing? So we spoke about unit trust, we spoke about investing in stocks, etc. What's the minimum amount that I need to walk into like a JMMB and start investing? Because again, we dispel the myth that JMMB is for rich people. No, that's not how we started. That's still not how we are. We started to give everyday Jamaicans access to investing, period. So today, what's the minimum amount that I need to walk in to start investing?
Right. So, Kerry, I would have given some indication to that earlier. If it is that we're perhaps looking at some of the funds, the unit trust, it is below $5,000. I've also indicated that if it is that an individual wants to invest in stocks, the minimum purchase unit is 1 unit.
Yeah. Cool.
One unit.
Wonderful.
So certainly, if we use the funds as a benchmark, so to speak, then it's less than $5,000 to get started.
Yeah, as a small investor. And of
As a
course,
small
the more
investor.
you have, so we're talking about, guys, a few meal deals from KFC and you're there, 1 or 2 meal deals, KFC, you're there. And of course, the more you have, the better. And once you get started, stay invested. Keep putting that in there. So, boy, Nadine, this was a great conversation. We're just going to do one final housekeeping matter before we go into what we call our final nugget, right? So just to remind everybody that, again, this session is being recorded, and starting between tonight going into tomorrow, it will be uploaded on all of JMMB's platforms on Facebook, Instagram, Twitter, and YouTube. So you can catch the replay if you didn't get a chance to catch the live. Follow JMMB or subscribe to our YouTube channel, just so you can stay posted. We're going to be back next week, Tuesday, with another great session, and I'm going to spill the beans just yet. So stay tuned to our social media platforms to make sure that you get all the great information and updates about what's coming up next week, Tuesday, same time, 8:30 p.m. Jamaica time, same place on JMMB Group's platforms on Twitter, Facebook, and YouTube. So stick close to us. If you found any of this information useful, then click that share button, share it again with family, friends, and loved ones. Slide into our DMs if you would like to have a conversation with us. Again, there's a lot of things that would be covered and you'd want to know, okay, how can I get a financial planning conversation? Then feel free to slide into our DMs. As you can see, it's very easy and inexpensive to get started investing towards your goals. So just to be clear on that. And before we wrap, now we move into our final nugget with Nadine. And essentially, Nadine, the final nugget is that section where we ask all of our guests on the live to give us an indication of recognizing what we just discussed tonight. So we discussed lots of things about investing and how to get started and the key things we need to know to consider before we invest and as we invest. But we're going to go to bed now, just about, and sleep and wake up tomorrow morning. In your view, as our final nugget, what is the first thing that you think we need to do as we wake up tomorrow morning to invest and get started and or improve how we invest? What's your final nugget? I think you're muted. Oh, no, you're not. Okay, sorry.
All right, so my final nugget to our investors is take the long-term view, stay invested, and stick to your investment strategy.
Stay invested and stick to your investment strategy. Okay, great. So in spite of COVID, in spite of the crisis, there's still opportunities. Stay invested, stick to your strategy. If you don't have a strategy, set one, have the conversation with your financial advisor, and get going. So again, guys, this was Investing 101. We really just touched the tip of the iceberg tonight because I see lots of opportunities to have this conversation, again, digging deeper into some other areas. We would have done a previous live, which we invite you to check out, called How to Keep Your Investments on Track During COVID-19. Please check that out as well, a replay of that. It was really a very good conversation. Guys, can we get a big up and an applause for Nadine? I see them coming in already. It's been wonderful, you guys. And of course, we do this for you, so we're happy when you join us. Yeah, it's curfew, and we know a lot of folks don't have nowhere to go, but they still choose to spend the time with JMMB, and we're very, very happy that you joined us. And of course, we're going to be back again next week, Tuesday at 8:30. Nadine, we thank you again for making your time and the expertise available to all of us here. I know I certainly benefited. And we wish you all the best. We encourage you to stay safe as we encourage everyone else to stay safe. Of course, I have to give my usual personal big up to the JMMB marketing team, who diligently and faithfully puts these lives together every single week. Thanks, guys. I really appreciate your partnership and support. And of course, again, a big thank you to all of our viewers who joined us. So again, everybody, stay safe, keep the connection going, stay in touch with JMMB, and God's willing, we will see you next week, Tuesday at 8:30. Thanks, guys. Have an awesome night.
Bye.
Bye.